but we can kind of see what happened. We paid more, but we got more done in the time, but we paid more. All right, let's move down to variable manufacturing overhead variance for this example. We got HMS Round Belly Inc. has the following direct variable manufacturing overhead labor standards for a styrofoam life vest. 1.4 standard hours per vest. All right, it's the same as we had in the direct or in the labor variance. It's the 1.4 hours per vest, but now we're looking at a different rate because now we're applying our variable overhead rate, and that's $6.50. All right, last month employees actually worked 5,500 hours. The same information, but and they made 4,000 vests. Actual variable manufacturing overhead for the month was 34,500. All right, let's put it into our formulas and see where we come out with the variances. So the same thing, actual quantity was the 5,500 hours. Put that, so we know what our total cost was, right? It was the 34,500, and we know what our actual hours were, it was the 5,500 hours. So we do the math to come up and see what our per hour rate is, and that gets us, and we already knew what the actual cost was, but I put this in there to do the math so that you can see on a per hour basis what our cost was, and also it depends on what the kind of information you're going to be given in problems you do at home. So that's why we're doing all the math here. Even though we're given the 34,500 up above as the actual cost, we want to see what the per labor hour is, and so that's why we divide it out. But the multiplication stays the same. We get 34,500 as the actual quantity times the actual price. Then we got actual quantity times the standard price. We know what our standard is. Our standard is $6.50, and then our actual hours were 5,500. Now, go over to the standard quantity and the standard price column. We got the 1.4 hours, which was what we expect per vest, and we did 4,000 vests. 4,000 vests is the actual quantity. So what would our expected hours be for 4,000? That's the 5,600, and then we take it by our expected rate. So this is what we'd probably expect to pay, and that's 36,400. All right, so it looks like we got some favorable variances on both sides. Round Belly experienced a favorable price variance because its actual overhead rate was 23 cents, and we got a little bit, a couple more decimal points, but essentially it's 23 cents less than the standard, right? So it was the $6.27, and then we have the rounding in there. It was less than the $6.50, right? So that's why we have a favorable price variance. Now, Round Belly experienced a favorable quantity variance because it produced 4,000 vests used 100 hours less than the standard expected. All right, so that's our first example. That's the styrofoam vest example over here on the left-hand side in green. And what we're going to do is we're going to look at journal entries for recording the standard variances, or how, when we're doing a standard cost system, how do we record the journal entries when we're using materials and when we're using labor. So down here in the middle at the red number 6, it's pretty small, but we packed it in there. What they say, get in where you fit in, so you put it there. We got raw materials inventory. We're going to debit raw materials inventory for the 4,515. Now, that's what we're gonna. That's what we would have expected to pay at that quantity. Right up here in the middle of the top box, the middle column is the actual quantity times the standard price, right? So we know we purchased 420 kilos, but we're going to record it at what we would expect to pay, the standard price. That's the $10.75. So that's why we debit raw materials for the 4,515. Now, when we go to pay, or when we record this, we know that our accounts payable, our vendor is going to actually want what we agreed to or what we bought, and that's the actual price. And the actual price, remember, was the 4,629. So we credit AP for the 4,629 because that's what we actually owe them, which is separate from the standard. We use the standard internally as an estimate, but when we go to pay someone, we actually have to pay them what we owe them. So that's why we credit AP for 4,629. And now the difference is materials price variance of $114. All right, that difference is a debit to the P&L, and it's similar. It's an unfavorable variance, and it's a debit to the P&L because we need to increase we estimated too little, so we need to increase the cost of goods sold, and we do that by the debit to the P&L. All right, but now when we transfer this raw materials into work in process, we're going to transfer it at the standard quantity times the standard price, because remember, the standard costing system is how we internally tracking. We do it internally track everything at standards because we set those standards at the beginning. That's what we expect we should do. So when we're recording and when we're transferring raw materials into work in process, we're going to transfer it at the standard price and the standard quantity. And then later on, at the end of the period or month or year or whatever, when we analyze our variances and we say, well, our estimate was wrong, well, anyway, we record it at the standard first, and then afterwards we look and we say what were our variances. So to transfer, we transfer to work in process at the standard quantity times standard price, which is the 4,730. Debit WIP for or work in process for the 4,730, and we're going to credit raw materials at the actual quantity times the standard price. Now the actual quantity times the standard price, because we're taking a quantity, we know it's a known quantity, but we're keeping it at the standard price because that's how we track internally. We track internally at its standard price. And then the variance between the two is a materials quantity variance, and it's favorable, so because we were able to do more with less, but we need to recognize the cost, and we would have over applied to the inventory, and so we need to reduce that. We need to reduce it because we did better than we expected, and that's why you have a credit to the P&L there. Now let's go to the labor, and we say, all right, when we're recording the labor journal entry, we're going to debit the work in process. Remember, because this is how we're going to track the inventory. We're going to put all the costs that we put into it, right? Direct materials, direct labor. Now, so we're going to debit at work in process at the standard quantity and the standard price, because we're saying we think it's going to take 1.4 hours and we think it's going to cost $20 an hour. So that's what we do. Boom. Debit work in process for $112,000. Now, when we go to pay our employees, they're not going to want what we estimated to pay them or we expected to pay them. They're going to actually want what we owe them, right? So we need to credit wages payable for the actual cost, the actual quantity times the actual price, which was the $120,000. $120,250. That's their credit because we actually owe that. We have to pay that amount. So we record that payable at the actual amount. Now the difference is we got to record, remember, the unfavorable $10,250 because we pay them more. So we need to debit. Unfavorables are debits. We need to debit the $10,250, and then we need to credit the efficiency variance, or we did more at the for the same amount of time, but we would have expected 5,600 hours, but there were only 5,500 hours. So we were more efficient, and remember, when we're more efficient, when we're favorable, that's a credit because our actual would have been less, and so we need to reduce the cost of goods sold for that amount. Those are the journal entries. Now, if this stuff is complicated, and trust me, it may be, go back and watch this again. Watch it again. Follow everything. Go through the given material. Follow it through. Do the math. You'll be able to understand it by repetition. That's what makes accounting easy. Is this information, you're going to see it in your homework. You're going to see in exams, but once you've got all the information and understand how it works all mechanically, it's just like plugging it into a formula, and boom, you're done. Now let's go to another example. Middle, we've got this gray. Number 7, we got all the gray boxes. That's going to be this middle information. We got HMS Round Belly Inc. has the following direct materials standard to manufacture one steel anchor: 25 pounds of steel at $1 per pound. All right. Last week, 15,200 pounds of steel were purchased and used to make 610 anchors. The material cost a total of $15,430. All right, same thing as when we were doing the life vest problem. Let's plug everything into our equations here, and let's see what the variances are, and let's explain those variances. All right, so the actual quantity, remember that was given. It's the 15,200 pounds, right? Now we want to come up with what it costs per pound. What did we actually pay per pound? And so we know that the total material cost was 15,430. We divide that by the total number of pounds that we used, and we come up with the actual per pound cost, which was $1 and $1. So 1.0151 doesn't work out to cents really well, but we're going to track that because that's to kind of explain our variance, right? So we're going to say, well, we know we actually paid $1 and then $1 and about 2 cents, but the rounding's there. So we multiply that out, we give our actual cost, and our actual cost is the 15,430, which we know, but we wanted to break it down because we want to see how much we paid per pound. All right, then we go to the middle. And we got the actual quantity times the standard price. That's what gets us to the 15,200. Now we'll go to standard quantity times the standard price. We know there's 25 pounds of steel. That's what we expect to use per anchor. So we multiply the 25 pounds times the 610 anchors, and then we're going to multiply that by the $1, which is our standard, which is what we expect, of $1 per pound. So we get 15,250 pounds times $1. That gets us to 15,250. All right, so we subtract the two, and we see that we got an unfavorable. Well, let's read it what it's given. Round Belly experienced an unfavorable price variance because it paid that the 1 cent and change, the 0.015 more per pound of its steel. And then Round Belly experienced a favorable quantity variance because it produced 610 anchors using 50 pounds less than the standard would have expected. Okay, so as you see, we would have expected to pay $1 per pound. Well, we paid more than that, so that's going to kick out an unfavorable variance. Then we would have expected to use a total of 15,250 pounds to make 610 anchors, but it was less. We only used 15,200 instead of the 15,250 that was expected. So that's why we had the favorable quantity variance. Now let's go to the labor variance example right here in the middle, still in the gray. We got HMS Round Belly Inc. has the following direct labor standard to manufacture one steel anchor. That's 4.8 standard hours per anchor at $22 per direct labor hour. Last week, 310 direct labor hours were worked at a total cost of $61,910 to make the 610 anchors. Alright, same thing as we did before. Let's put it into the formulas. We got 310 hours, or sorry, 3,010 hours times, and we're going to break it down. We're going to figure out what our actual rate was. So we're going to take our total cost divided by our total hours. We're coming up with a total direct labor hour cost of $20 at 0.568. So it's about 57 cents, but I've kept that in there so that you can see when we do the math and then when we do the analysis. So it's about $20.57 is the 20.568. So that gets us to our total cost, and the total cost was given, but remember, we want to break it down so when we do our analysis we can see better exactly what happened. So we got the 61,910. Now let's go to the middle. We got actual quantity times that standard price, and that gets us the 3,010 hours times our expected